Well, good evening, folks. Hope everybody's doing well. So, tonight we're doing a little bit of a lecture here on some important information about finding setups. And I get a lot of questions as a mentor teaching Forex and recently index futures. And the things I'm going to talk about tonight are not limited to any one particular asset class. So, it's kind of like remove all of the uncertainty of where you're supposed to be looking in the charts. When am I supposed to be utilizing electronic trading hours? When am I going to be referring to regular trading hours? For what reason? What type of setups form when? And that way it allows you to have a setup for life. Now, some of you may have thought this was going to be a pattern or a PD array lecture. It's not. I'm teaching you how to find your own setups, but specifically when and where they form. That's the part that is always a constant. That's the thing that a lot of new traders and those that are struggling as a break-even trader lose sight of. It's a matter of knowing what to look for and when. It incorporates market profiling, and that is not market profile in the sense that we're using like VWAP and things like that. We're talking about schematics, things that I've taught and have shared publicly on this YouTube channel. You can find that information in the core content where I'm dealing with specific day profiles. The topic would be under day trading. And I cover a lot of this stuff also when I'm talking about specific market reviews. And I understand that many of you may be new, okay, and you want a 1, 2, 3 easy, get me in and get me out pattern. And I've already produced all that. Okay, it's on the YouTube channel. But for the folks that really want to find a lot more setups or not be limited to a one-trick pony, not that that's a bad thing because the 2022 model is excellent. The optimal trade entry pattern is excellent. So when I talk about these areas in the marketplace tonight, and I promise we will not be here very long. Usually when I say this on Twitter, and I do a Twitter space, we go for hours and hours. And it doesn't feel like hours to me, but I do have a time limit tonight, so I have to get through this. And because of that, I presented it in a PowerPoint presentation, so it helps me keep my focus. So I always have some kind of a monologue coming in. So I want to kind of set the expectations for everyone that's going into this study, so that way you know what it is that you're going to be trying to glean from it, what's the purpose. And then we'll get down to the nitty-gritty. It'll be right to the point, and I'll show you some details in terms of executions and such. So algorithmic trading with ICT models for all assets. And again, the premise is one trade setup for life. Now, what do you think that would entail? Something that would repeat over and over again. It's not ambiguous. It's very specific. Now, when you see me doing my trade executions, sometimes they look too good to be true. And sometimes I'm questioned as to whether or not I'm using something that's delayed and whatnot. And today I had a little bit of a clinic today. I've shared some things that my wife wasn't expecting me to spend any time online today, but I felt like I wanted to share today. And I answered a couple of things that came up over the years in terms of doubts or concerns. And I really want you to think about the lesson tonight that we're going to cover and think about how your setup, your multiplier, the PD array that you gravitate to most. It may be the fair value gap. It may be a breaker pattern. It may be the optimal trade entry pattern. It could be a simple order block. It could be a turtle soup. It could be a number of things. It could be the inversion fair value gap. Whatever that PD array is that you see easily in a chart, the one that you don't have to look too hard for or strain your eye or scour through the candlesticks to find it, the one that just simply makes sense to you. When you see price action, your eye goes right to it. That, my friends, is the one you're supposed to be looking at. That's the one you start with. It does not mean that that's going to be your entire career. It just means that that's the one that resonates with you right now as a new student of mine. And then you grow from that. I promise you, when you learn one PV array and how to use the information I'm going to share tonight, it'll be so much easier for you to see all the things that form in all the PD arrays that I've taught and will teach. But you have to have some kind of a baseline to grow from. And if you're rushing through it or trying to push too much on yourself, the time limits that you place on yourself for learning how to do it is unrealistic. Some of you are going to learn sooner than others, and others are going to require more time. I can't speed that up for you. You're bringing in your own learning curve, and the things that you're going to worry about are going to find its way to the bin as you learn how to focus on the things I'm teaching you, and not anything more than that per lesson. So let's get into it. All right, so draw on liquidity. Okay, it's the sole purpose of price delivery, and I wish to thank Patrick Wieland for getting this screenshot from his live stream today. I needed to make a point about liquidity and the resources that are available in the market today, and how I'm going to help you not lean on tools like this. Now, admittedly, if this type of thing was in existence when I first started in the 90s, that's the 1990s, by the way, not the 1900s, as my youngest son always says, makes me sound like I'm really, really old. But this is a screenshot of the book map, okay? I am not a affiliate with them. I'm not suggesting that you should subscribe to it, and I'm not trying to kick dirt in their face either. I'm just saying that the primary function for that tool can be made redundant with tonight's lesson. Now, I don't want you to take my word for it. You're welcome to compare and contrast and then see if there is any validity to what I'm going to say tonight. But I promise you, you're going to see that these things, while useful to a new student, to a new trader, they're absolutely wonderful crutches, and that's not to be demeaning or to talk down to it. Because believe me, if I would have had access to this when I first started, I would have absolutely subscribed to it, because it would have helped me learn faster the whole premise of liquidity. But the problem is, with a tool like this, it kind of like brings more attention to levels of liquidity that are not so pertinent to right now, okay, or what's about to take place in terms of a narrative and price action. Okay, and when I teach smart money concepts, by the way, when you hear SMC, it's my concepts, okay? When I talked about it and first started teaching it, I referred to them as smart money concepts. And when we look at liquidity, there's a specific range in mind. When I'm looking at my charts and I hear or see people in comments, I've watched other YouTubers, and their complaint is, you never really understand why ICT is picking this high or that low. He's hiding it from you. That's bullshit. Tonight, I'm going to show you that that has never been the case. I've always said these things, but it's always tucked in during the discussion, the boring parts, because you're not trying to listen. It goes over your head. That's why when you go back and look at old videos, it's been there the whole time. But you're looking for that one trick pony, that magic trick, that sleight of hand thing that's going to let you go out on social media and look like a rock star. If you want to be able to do that, you have to learn like tonight. This is a lesson that gets to the heart of the matter. Where is it that you should be framing your focus? And what liquidity? What specific liquidity does ICT refer to? Yes, we're going to cover that. And you're going to see, by contrast, if you look at the things I'm going to cover tonight and utilize it with this resource here, Bookmap. I don't know if they offer a free trial. I don't know that at all. But there's YouTubers out there that stream and kind of like share this because they're affiliates and they want you to sign up with them. I'm not saying don't use it. I'm not saying you should use it. I'm just saying that for folks that are trying to do this without having extra things to pay for or look at, you can take the information tonight and compare and contrast and see if it doesn't really get to the heart of the matter in terms of where liquidity is should be focused on for any one given period in intraday. All right, so when we first start talking about liquidity, the assumption is you're a day trader, whether you're a scalper, whether you are a session trader, a intraday day trader where you're trying to do the entire daily range, or if you're just a short-term trader or you're looking to time the market for your longer-term swing trade or position trade. All of that is encapsulated in tonight's discussion. So it's not just an intraday chart concept. You can use these concepts to really narrow down the amount of risk, reduce it to minuscule amounts. It doesn't mean it's without loss. Doesn't mean that you will have winning trades all the time. It just means that if you understand the concepts I'm covering tonight, you will have the ability to go in and fine tune your risk model, be able to reduce the amount of risk that's associated with your trades, and also time the market. Know where the market's going to go to next. Okay. First session we're going to talk about is the PM session ranges. Okay, and this is always going to be referred to in terms of previous day. Okay, so previous day, we are going to be referring to the 1:30 p.m. to 4 p.m. time window, and this is always in New York local time. Now, I'm saying that because I want you to set your trading view chart to New York local time. I say this as much as I can in all my lectures because I get confused when I talk to people around the world and you're in different time zones, and I have made mistakes in terms of telling them what their conversion would be. So to eliminate all that confusion, if you just simply set your charts to New York local time and look at the charts that way, all the confusion goes away. It's very simple. So PM session ranges, you're looking for the highest high and the lowest low between 1:30 p.m. and 4 p.m. Now, is there any ambiguity there? No. It's very simple, succinct, right to the point. Now, what do you do with it? If you are bullish, okay, and we are trading in close proximity to that range, as we see here, this example here, I'm using the June contract before rollover took place at the time of this recording, and live stream, we are looking at the September contract for the indices for 2023. But I'm showing you an example because this is something that I utilized in commentary, something I used in terms of my own analysis and executions and such. But I want you to understand that when we look at PM session ranges, it is always referred to in regular trading hours. Notice this down here in the lower right-hand corner. Let's make the chart a little bit bigger. So down here in the right-hand corner, that RTH, that's regular trading hours. Now you can toggle this if your membership permits you. I don't know what, I guess, membership is required for TradingView. If you're absolutely against TradingView, then I'm sorry, you're going to have to find the equivalent, and I don't know what that would be for you. Okay, I chose TradingView because my community said go to TradingView when I left MT4. So we're all here now, and I don't know what it's going to cost you. I don't have an affiliate program with TradingView. I get no money for it if you subscribe to it, and I don't know what the amount of membership would be to allow to get that. I don't know. Okay, so give me the liberty and latitude to be able to talk freely, and you're going to have to work that on your own. But this toggle from RTH to electronic trading hours, ETH, okay, one or the other is going to be utilized. If we're going to be looking for PM session ranges, it's always going to be into previous day. The time window, the amount of time that you're looking inside of, what price range, what high are you looking at ICT, which low are you looking at ICT, regular trading hours, it cuts out all the overnight trading. The algorithm, once we start trading regular trading session hours the next day, it's going to refer back to these specific times. And what liquidity exists above and below it. So if we're bullish and we're trading near the opening in this little orange line here that's going to be in every slide, that denotes the 9:30 opening bell. You know, when everybody's on CNBC and they clap their hands, that's when the opening bell occurs for the stock indices and stock market. Now, obviously, they're trading all night long, but that opening window starts that opening range for the next 30 minutes. Where will that usually run for? The high or low? If you're bullish and we take out the PM session low, where it's going to be sell side below that, that's wonderful, because if it's bullish and we have a higher time frame premise that's expecting the market to go higher, how do we know that? That's what I've been teaching you. When I do my reviews or I do my commentary, or if I'm pointing to something on Twitter, if you're not following me on Twitter, you're really missing out, because I'm doing a lot of information there in like real short, succinct manner. I'm taking your attention to right then and there. Today I did it, and a lot of people actually followed it. And it's not to be used as a signal service, but I'm calling things live there, drawing your attention to it so that way you can study it real time. But if you're bullish and the market drops down below PM session lows, notice that this low here and this low here, that's encapsulated inside of the 1:30 to 4 o'clock New York local time. So below those relative equal lows, there's sell side liquidity. It's really simple. It's simple, isn't it? When you go through the process of listening to me and doing the things I tell you to do, and I justify why you should do all these things, that's the boring parts. The folks that have started making real money, 6 figures, payouts, okay, doctor salaries in a month or less, that stuff comes by listening and practicing and going into their charts and not taking my word for it, but going in and seeing if the things I'm saying are indeed true. This logic, if we're bullish, we'd like to see sell side taken. Why? Because that means that smart money would accumulate those sell side liquidity and absorb it for their buy side. So they're going to treat that sell side as counterparty to their smart money buying. So they're accumulating in the Judas swing. The drop down here just goes into this area here where the liquidity is. So we definitely want to be looking at previous day's session, not just any old high and low, the high and the lows between 1:30 and 4 o'clock New York local time. That's the PM session. That range, the highs and the lows, there's liquidity above and below it. If we're looking for higher prices, we definitely expect it to be running to the buy side. But at the opening, we expect, not always, but we anticipate a run lower, that Judas swing, that every Tom, Dick, and Harry on social media are going to chase that. They're going to think it's breaking to new lows and it's going to keep going lower. No. It's only running down there to take sellers into the marketplace, and they're going to buy them. And then the market runs to the buy side. Now, you could be a trader that simply takes this order here as a long, as a turtle suit. Now, admittedly, this takes a great deal of conviction. It probably won't be the first thing you reach for learning from me. In fact, it took a lot of time for me to trust that idea of buying below old lows and selling above old highs for entries, not targets. It's easy to do it for a target, but it's entirely different. It takes an entire paradigm shift in your thinking to go into the marketplace and anticipate that as an entry. But it can be done, and it takes time. How you get there is you study old moves like this and you journal them. But your model could simply be wait for the sell side in the previous PM session range. If you're bullish, that's your buy. If you're going in, that means that you're expecting the weekly range to expand higher. The draw on liquidity higher on the weekly time frame. We covered all that stuff in the previous discussions. But going down into liquidity like this when we're bullish, we would reasonably expect it to run for what? The buy side. Where? What buy side? What high are you looking at, ICT? That one right there. Why? Because it's inside the range between 1:30 and 4 o'clock. How, pray tell, is that complicated? It's not complicated. And I've taught this ad nauseum over and over and over again. But you're not listening. So I'm taking you by the hand tonight, right into the charts. That way everything is perfectly laid out for you. You have absolutely zero excuses. You have no excuses now to know what I'm anticipating. What range am I looking at? I'm not hiding it from you, folks. I want you to succeed. I really, really want you to succeed. And if you can't learn it from tonight's lesson, I don't know how to do it better than this one. Okay? Going further into the day, now we're considering a full 24-hour rotation. Okay, so over the course of 24 hours, what is the mind of ICT? What are the inner musings of Inner Circle Trader? I'm going through the process of going through this very routine right here. I look at PM session range. If it's not a factor or it's not to be considered because we're not in close proximity to that range, because we could be significantly higher or lower around 9:30. So what am I looking for then? If I'm not close to previous PM session 1:30 p.m. to 4 p.m. range, at the time of 9:30 at the opening bell, and I'm watching that next 30 minutes, which is the opening range, what am I going to look for then next if it's not that? I'm looking at the London session raid. That means I'm going to be looking at the range between 2 o'clock in the morning and 5 o'clock in the morning, New York local time. Now again, tell me, is that complicated? No, simple. So in your charts, you want to be annotating what those levels are. Now you can do it like this here, where I have actual annotations that I hand draw. I don't have a indicator thing that plots them for me. I prefer the high touch over high tech. It means I'm putting some thought into it. I get closer to the marketplace by doing that and sharing it with you. I just don't trust an indicator to do it. Okay, so I'm an old guy, I'm a dinosaur. I'm used to doing everything by hand anyway. And believe me, it doesn't take that long to tell me you have to have it because it saves time. It's a cop out. You just are lazy. There ain't nothing wrong with lazy. I mean, lazy people can do things very efficiently if they're smart. But let's zoom this in here. All right, so London session raids. If we are not in close proximity to the previous PM session at 9:30, remember this orange line here denotes the 9:30 opening bell of the stock market. So where are we at in terms of proximity? So we're starting the trading here. So where are we? Are we in close proximity to a PM session high or low? But we are in close proximity to what? London session buy side. We're digging into that. So all of this can be viewed pre 9:30 as a Judas swing. Now notice, am I showing you regular trading hours or electronic trading hours? Electronic trading hours. So that way you're going to be able to see the overnight trading. If you have it toggled to regular trading hours, you won't see this information, folks. It will be hidden from you, which is one of the conundrums that retail traders fall into. They don't know either how to toggle electronic trading hours or regular trading hours. And even if they do, they don't know what to do with the information. It's hidden. It's in plain sight, but it's hidden from them. You don't have that excuse anymore tonight. So London session buy side liquidity, we're seeing that raid up into it here. And then where's the low in that? Remember, 2 o'clock to 5 o'clock in the morning, New York local time. That's not ambiguous. What is the range? The highest high and the lowest low. Here and here. So if we raided the buy side and we did it on a run that's a Judas, we anticipate that as a false run higher. And then we're going to see, does it shift lower? How can we use that information? Well, you can use the 2022 model. You can use a breaker, a bearish breaker. You can use the ICT optimal trade entry. In here, from this low to that high is a fair value gap. This is a shift in market structure below this low right there. That's your 2022 model or optimal trade entry. What would you be aiming for? London session, sell side liquidity. Do you have to sit through a retracement? Yes. but we'll cover that because that in itself is also a range that we utilize intraday. Notice when I'm taking you through the whole routine of 24 hours. Where are we at open? Open is 9:30. We have to wait for 30 minutes because there's going to either be a run higher or lower, or it may consolidate, and then we'll have to wait for the 10 o'clock displacement, and then you can look for a silver bullet between 10 o'clock and 11, or you could use a run into the lunch macro, which we won't talk about tonight, but I promise you I will be teaching those things. I can't do everything in one lesson. Everything line upon line, precept upon precept, it'll be taught here and there. But before November, you'll have more than you'll ever need. So we have two ranges we've identified here for defining where liquidity is. Let me go back to the discussion of that Bookmap application or software. I want you, if you have availability to do this, look at what Bookmap is saying when we're trading like here. Tools like that will start showing you lots of liquidity, if they're accurate, right below that low. If it matches the premise that I'm teaching here tonight, then it's valid. And that's where the market will draw to. Every small little liquidity above the marketplace or below the marketplace is irrelevant. When I say I'm looking for a draw on liquidity, I'm looking predominantly around the levels I'm teaching you today. So think about how many times I've called things on Twitter live and how many times they were wrong. What, 3 times maybe? Everything's on Twitter. It's not deleted. It's not edited. I don't do any of that stuff. But all of you, 300,000 plus now, have watched me take your attention to a specific price point, and then the market ran off and went right to it. How was I doing it? It's what I'm teaching you tonight. You can do this, folks. Now, there are going to be times when you look at the market and it's not going to be clear to you. If you don't have a clear depiction of what should be taking place, where the market should draw to, because there's going to be times when I'm either going to be on vacation or I'm not going to tweet or I'm not going to talk about something. I'm living a life. So if it's not clear to you what it's reaching for, don't put a trade on. Study it. And that experience will grow over time. And you'll get better at doing it. But when you're journaling, I want you to go into your charts and journal like this. This should be part of your journaling. If you don't journal and you don't record these types of things, your brain and your subconscious can't retain it. It needs to be trained and conditioned. That way it activates your reticular activating system. So that way it allows your mind to see it. And then when you're looking at price action live, it'll be like, oh, I got to look. Oh, there's that high I'm looking at. There's that low I'm looking at. Notice we're cutting through candles, folks. It's not supply and demand. And it's not Wyckoff. I'm sorry. I wish it could be something I could point to and say, go over there and learn that. But it isn't anywhere else. All right, opening range gaps. Okay. Opening range gaps are a specific event that takes place when you're utilizing regular trading hours. So let's zoom in. So down here in TradingView, you want to make sure you're toggled to regular trading hours. By doing that, what it'll do is it'll remove all the overnight trading, so you won't see anything like London or anything like that. Where we stop trading for the regular trading hours, and where we start trading again at 9:30's opening bell. That's what you're seeing, okay? That separation, that is my opening range gap. So whenever you hear me say an opening range gap, not to be confused with opening range. Opening range is the first 30 minutes. I will have a specific teaching in its entirety, all by itself on this video, on this channel. It'll be opening range lecture. But when I say opening range, that is the first 30 minutes after the opening bell at 9:30. So specifically, it's 9:30 a.m. New York local time to 10 a.m. New York local time. Not ambiguous, is it, folks? Very, very specific. This opening range gap is where we stop trading using regular trading hours and where we open up at 9:30. If there is a gap lower at 9:30, you will see this gap here. It's being shaded with this little orange box. It doesn't mean it wants to run up there immediately. Okay, and this is what I watch a lot of YouTubers that understand there are gaps. I didn't invent a gap, but I did codify some things around how to use that gap. And I'll teach more about that also in its own lesson. But tonight, I want you to think about how where the market reaches for liquidity, where it reaches for that liquidity, and where does it want to go to after it goes there. This low over here, right in here, that low is occurring in the morning session or the AM session between 9:30 and noon. So what would be residing below that? Sell stops. So we call that sell side liquidity. So we gap lower and then run into that liquidity right there using regular trading hours. Now, if you're using electronic trading hours, you may have a lower low overnight. And then, in other words, between these two price points here, where we closed at regular trading session and open at regular trading session, between those two price points, you have all of the 6 p.m. to 9:30 in the morning worth of trading that could have made a lower low here. I don't care. What? I don't care. If I'm going to refer to the opening range gap and we get a gap lower like this, I'm filtering out all of overnight price. That's it. Now, is that ambiguous? Is that complicated? No. What low would I be looking at? Well, on regular trading hours on this chart, that's a pretty obvious low, isn't it? That's the stuff I've been doing on Twitter. I'm picking the right highs and lows, folks, because there's a method behind what I'm doing. I'm not inventing it as I go. I'm not going off on a whim, making it up as I go. I've been doing this stuff for 30 years. It's the same stuff all the time. It's a well-written, well-read novel to me. That's why I'm so consistent. That's why I'm accurate. And if you stick to these rules, you will become this accurate too. It's transferable. You should be excited. I know some of you are grinning like shit right now. You're thinking, man, if I would have had this stuff just a couple months ago, I could have passed my funded account challenge. I could have done this. I could have done that. I could have bought a boat, a jet ski, a car, a down payment on a house. But you have to go one step at a time. Now, the opening range gap. If we run to a pool of liquidity like this, here, wouldn't it make sense, since we're now into a discount and inside of liquidity, below old lows, we're in sell side now. We've already moved a lot from the previous session, here to here. What would be reasonable? Well, look at the economic calendar. Today we had the Fed Chair Powell jawboning at 10 o'clock in the morning. Do we trade around Powell or Fed Chair testimonies? No. Not if you're new. Not if you're trying to keep your money. Not if you don't want to be a gambler. You wait. And you wait for what? The PM session. Exactly what I said this morning on Twitter. I said today and tomorrow, Fed Chair will be testifying. So you want to be what? Trading the afternoon. If you're going to trade at all, the probabilities are going to be high in your favor if you wait till the afternoon. That means 1:30 in the afternoon, New York local time, to 4 o'clock's close. Is that ambiguous? Is that complicated? No. Wouldn't you know it, there's a low here that forms at 1 o'clock, and then at 1:30 or so, it creates another low here. That's pretty interesting. What happens after that low forms? It runs right on up into that opening range gap. So all of this mess in here, every Instagram trader, every Twitter hero, every YouTube trader, live streamer, they're in there trying to look for patterns when there is nothing to trust. It's going to be running around, going amok, just seeking liquidity, and it'll frustrate you. That's the reason why I tell you to focus on the sweet spots in the marketplace. I don't care about retail Rick that's going to come after the fact, because he's not going to tell you on Twitter when I'm tweeting and saying, oh, you said don't do this, I'm going to go in here and trade it. They don't ever do that. They'll come back 2 hours later and they'll say, look what I did over here. So stop listening to those neophytes. The logic that I'm sharing, don't take my word for it. Go into the charts and you will be convinced of it. 100% guarantee, I guarantee you, you will see this logic there. So it runs up into the opening range gap after the New York lunch, after the morning session chop, and it runs to a logical level based on the information I'm showing you here. See, in the morning, a lot of folks that understand this gap exists were looking for any reason to run right up there then. No, they're not going to see it. Why? Because they don't understand time. The algorithm runs on time. It engineers liquidity in the morning session, and then it engineers it going into lunch, and then it runs on that liquidity. Why would they want to do that? We'll talk about that. New York lunch raid. Now, in the old days, and I was trading when the old days were the thing, before electronic trading, we had open outcry pits, and when you called into the broker, they would answer the phone. You had to wait for them to answer the phone, by the way, and then get transferred to the trading desk that you are seeing the account managers for that account that you have. And you got to go through the process of giving them your account number and then your PIN, and then you got to give them your order. They repeat the order the whole time the market's trading. Then they ask you if you want to wait for your fill. And if you say, I'm going to wait for my fill, you're put on hold for a minute or two. Then they come back and they tell you confirmation number and where you're filled. And many times you're upset because you have real slippage. Because you're all spoiled. You know, press a button, you're in there, right? And the open outcry and the pits would have a lunch hour where it was very, almost like a routine. Unless it was a big trending day, the lunch hour between noon and 1 p.m. New York local time would generally be a consolidation. Now, the way we could use that back then, and I'm going to show you how I use it now, but for historical purposes, I'm giving you a reference on how I become ICT. The lunch hour many times was a reversal, and whatever took place in the morning was completely reversed on, and then if it was a trending day, it would just keep on going, and it would repeat whatever the morning low was up to the lunch high, and then run into 3 o'clock, 4 o'clock, and that would be their full daily range. Other days, if it was bullish, it would go up and then consolidate during the 12 o'clock and 1 o'clock in the afternoon, and then do the same move in the afternoon between 2 o'clock and 4 o'clock that it did in the morning session, but it would do it in half the time. So it was a measured move, ABCD type of profile. And in other days, you would see just a morning move and then consolidate lunch and then stay consolidated the rest of the day. And the same thing if it was a bearish day, it would create the morning move, then consolidate in lunch and do nothing extra. And that was pretty much it. That was the profiles that existed back then. Now, you might be thinking, well, that's all well and good, Michael, but which one do you use? Well, which one would you expect based on the economic calendar, the draw on liquidity for the weekly range? What is it trying to do? Where's it reaching for? All those things have to be balanced. That still requires you and your study to get to that degree of understanding and implementing the things I'm teaching. But you have no excuse when I'm pointing to it in advance. I'm taking you to the higher time frame weekly charts. I'm telling you where the market's going to go, and we watch it daily and weekly move thousands of points. Not 5 handles, thousands, hundreds, okay? So it gives you time and opportunity to get in sync with that type of move. And you don't have to have the lowest low and the highest high. So a New York lunch raid between noon, New York local time, to 1:30 p.m. But ICT, you just said it's an hour long, noon to 1:30. And there's people out there say, oh, the market doesn't care about, nobody's going to lunch. The algorithm doesn't take lunch, but it runs on that liquidity. So everything that was utilized since the dawn of market manipulation, when the powers that be figured out that they could just run a numbers game and everybody thinks it's a free market and they think it's buying and selling pressure that makes these markets go up and down and where they go. They utilized that information that it was not efficient at all when it was used in an open outcry. And that price, that manipulation, that engineering of market direction was made much more efficient when electronic trading took over. So nothing has changed in regards to market manipulation and market making. We're not talking about dealers, folks. Okay. If somebody's out there saying, I'm a market maker, I'm a former market maker, you are not a market maker. You are a dealer. The folks that are in control of price, where it's going to go, how high it's going to go, how low it's going to go, that's who I'm talking about. And you don't see them. They don't have a face. All of that's been changed now, and it's algorithmic. It's highly efficient. They never get sick. They never mess up because it's 100% electronic. It's following code. It's following instructions. Period. It's all delivered on time. So a lunch run on liquidity, a raid, if you will, you have to define the range between 12 o'clock and 1:30. But you said it's an hour long. 1:30 starts the PM session. That's when the algorithm can start doing its macro. A macro is a short order of instructions that will create an event in price delivery. Your focus needs to be on the highest high and the lowest low. I'm showing you the highest high in 12 to 1 o'clock because there's nothing higher than the high here. The low formed here between 12 o'clock and 1:30, that's the lowest low here. So we see this low, it drops down there. If we're expecting price to be bullish and it's not done anything in the morning, Powell's talking, there's a afternoon event that's expected like FOMC, something to that effect. You avoid the morning session. Let everybody else chase everybody else's opinion and ignorance on social media. Everybody's looking for the guy with the hot hand, the guy that's doing all the trades, the guy that knows, or the gal, in deference to the ladies that do trading. They're looking for the people that have something to say about the market right now. And if they've been right in the past, well, damn it, they're going to be right today. Let me follow what they're doing. No. You trailblaze your own path using this information. You will be confident that you have no requirement to be in anybody's membership or audience. You'll be able to do this, make your bread, and then go live your life and do whatever you want to do. Not be chained to these charts. Not looking at what I'm doing on Twitter. Because in November in 2023, that stops. You have to do all these things on your own. And that should not be scary. It should be exciting. I'm excited for you. But the session high and the session low for lunch hour, well, I guess it's really technically 90 minutes, isn't it? Did you say 90 minutes? Whoops. The low here, we can see it running down, taking that. When we're expected to go higher. What do you think exists up here that's not being noted on the chart? We'll get back to that. The market starts its run at 1:30, completely random. Now, you're probably watching this video and you've never seen anything else by me or never listened to Twitter Spaces that I've done. And you don't know that I've said that time at 1:30. You don't know that I've said this many, many times, referring about the New York lunch and how there's an algorithm that controls price, and there's a macro that begins at 1:30 that sets the tone and pace for the 2 o'clock to 3 o'clock silver bullet, baby. Hmm. The dots are starting to connect, aren't they? Starting to see a little bit more of the tapestry that's eluded you and everybody else out there that doesn't believe there's an algorithm, doesn't believe that these markets are absolutely controlled by AI. I promise you, that's exactly what's going on. We want to see when we're bullish, the market drop down and take out the New York lunch lows. Even if it's going to reverse, you can trade that here. How can you trade that? Wait for a shift in market structure. Fair value gap. Don't trust the 5-minute chart. I've already shown you today using a 15-second chart, and we'll get to that too. What do you say? A 15-second chart? Yes, yes, friends and neighbors. Price is price, and you have to look where the inefficiencies are. And every retail trader is using a 15-minute chart, an hourly chart, a 4-hour chart, and there's this taboo around 5-minute charts or less because they're not informed. They're not initiated. They think it's noise. They're part of the Goldman Sachs cult. Sorry, boys, but price is price, and whatever you see in terms of measuring it using a time-based chart, you have every advantage using a time-based chart. In fact, that's the only way you're going to see it. So don't listen to people that say, don't look at the time-based chart. It's nonsense. Wrong. Right away, that tells you they have no idea. Algorithmic delivery, it escapes them. Sorry. It runs on time. Time is the first factor. What am I showing you here tonight? Very specific windows of time and what to reference it in terms of liquidity. Go back and look at my examples, folks. Your draw's going to hit the floor. It's always been there. And it's always been explained to you in those long-winded rants. This stuff that you say I'm boring. No, I'm teaching you. I'm trying to teach you everything that would bring you as close as I can bring you without having the 30 years experience I have. So I'm taking you fast track through 3 decades of understanding. And if you don't have the patience to sit through whatever the duration is for the lecture, that's a little bit myopic and unrealistic. You're selling yourself short. I don't care if you learn it, really. And if you're going to be lazy, I don't care. But if you really want to learn it, I'm telling you what to do. I'm telling you what to avoid, where your focus should be. If you're bearish, you can wait for a run up into the opening range gap, take out a lunch buy-side liquidity pool, and then watch and see how it trades back below the New York lunch high. If there's a displacement, what does that mean? See that low right here? Displacement. What does it leave? This candle's high and that candle's low. What is that? That's random. Look at that. It's like it's just, it has no rhyme or reason, right? Wrong. That's your 2022 model. Boom. Sell short. Aim for what, ICT? The New York lunch low. Well, it made this one here at 1 o'clock, but you can use this one while you're long or bullish. I know it looks cherry picked and talking. I promise I got something for you that are thinking that right now. I promise you, just sit tight. But in the afternoon session, you can see how that lunch hour plus 30 minutes, that 90-minute window, that low right here is where sell side resides. And in the PM session, it raids that liquidity. But ICT, look, man, there's some relative equal lows down there, and you teach relative equal lows, right? But before you get there, where's the next logical range to look for in terms of liquidity? That lunch hour or 90-minute period. Now, I said a lot of talking about things that some of you get pissed off about because you think I'm thumbing my nose at you or talking down to you. But no, I'm talking to you like a friend. If you were friends with me from childhood, this is exactly how I talk to you. I know what I'm talking about. I know how to make crazy ass profitable traders. But I also have students that are fucking lazy. They're not going to do what I tell them to do, and they're going to make excuses why they failed because they didn't listen and they rushed too fast to get into live trading. That's your mistake. That's not my mistake in hiding things from you. I didn't do that. I'm not doing it here tonight either. You have every advantage after tonight. Going in and looking at what I'm looking for. Where am I focusing? I promise you, after tonight, your shit's going to be different. Yes, it's going to have nuts. AM session ranges 9:30 in the morning to noon. So right away, we are considering this in the afternoon. So we can always refer to it in the same trading day. So we could be anticipating a market reversal profile, something to that effect. If we have an elongated market where, say, the New York session, morning session rather, of the current trading day is consolidation. And then we have a directional lunch hour, or during the lunch hour, it's consolidation as well. We can refer to, and if we're bearish, we look at the previous session's trading. Now, if you look at the previous session and you're using electronic trading, what specific low am I looking for? I'm looking at the 9:30 in the morning to noon. If I'm not going to look at the PM session range, remember I'm taking you to very specific pools of liquidity. I'm going to look past the PM session. Well, why would I do that? Because we're already trading below it over here. So would I refer to it for sell side? No, we're already below it. So if I'm bearish, what am I looking for? What low am I looking for? Which draw on liquidity am I looking for? In this regard, I'm using the AM session sell side liquidity. If I was bullish, it would be everything I just said here in reverse and opposite. I would be looking for the buy side. But if we're bearish, I'm looking for very specific pools of liquidity. If I showed this on regular trading hours, it would still get that low. Very important. Even though I'm showing you down here the electronic trading hours, I'm doing this for the sake of showing you an understanding that whether your chart is on regular trading hours or electronic trading hours, and I'm looking at the previous daily range, or if I want to trade below yesterday's lows, what low am I looking at? The PM session low or the AM session low? Very, very specific. Not ambiguous. Not, well, I don't know which one he's looking at. He's always changing shit around. No, I'm not. It's always the same stuff. Always the same logic. Always the same logic. What's changing is the profile that I'm operating in because the market's delivering a specific way and I have to adapt to that. And then I anticipate. I'm not reacting to price. I'm anticipating where it's going to run to. What does that mean? Everything I'm teaching you tonight. Now, I don't expect you to watch this tonight and walk away feeling like you know everything about what I just said. You're going to need to watch it a few times. And if it's something you don't want to do, you won't learn it. I promise you, you won't learn it. One time watching, it ain't going to work. You need to listen to what I'm saying in here and then go into your charts. Spend weeks and months going back through it. That's what will convince you that this is sound logic. It's not contrived. It's not conjecture. It's not made up. It's absolutely what the market does. Every week, every day, and it will not stop. So you can see the previous AM session low over here, sell side liquidity. This dotted line here denotes we're looking at the 20th of June, 2023. So I can't use the afternoon session high and low because we've already, starting at 9:30, we're already below that. So what am I looking for, ICT? What am I supposed to be looking for? That low. It doesn't matter if it was a lower low, okay? Listen, if there was electronic trading hours showing and it had a lower low and it went below that low here, I would still, listen, I would still refer to the PM session range, as I mentioned a little bit ago in this presentation tonight. And before that one, I would go to this specific range here. It's a specific time. I don't care about overnight highs and lows. I'm looking at very specific regular trading hours. Regular trading hours is going to be referred to in the next trading session. They're either going to be respected or blown out. It's simple. That's not hard. All right, so let's blend some things here, okay? So as you can see, we have several things here in this chart, and this is today's trading, the 21st of June, 2023, and it's the E-mini S&P. And I photoshopped some things in here. I'm obviously being facetious by saying that. The opening range, as I taught you here tonight, that was one of the factors I utilized today. If you're following me on Twitter, I showed my PM session trade, which is what you're seeing here, using everything that I taught you tonight. Let's go through it, okay? This morning, we were watching Fed Chair Powell give his testimony at 10 o'clock. And I had my favorite usual suspects that I like following on Twitter. Not Twitter, on YouTube, rather. And those that were live streaming, I listened to them. And no disrespect, gentlemen and ma'am, they had really no idea what was going on, which is exactly what one would expect, because the market's gyrating and going sideways. It's just churning up accounts, going sideways, beating up everybody. You have to wait until we get through lunch. If Fed Chair Powell is going to talk, and it's a 10 o'clock testimony or whatever, wait for lunch. Just wait for lunch. If you do that, you will get the cleanest setup for the day. The easy, what does that mean, cleanest setup? Like, what do you mean when you say that? Where everything just simply jumps off the chart and it makes itself very obvious. You want setups that are very obvious. That's clean, okay? I don't want you as my student going into the marketplace and trying to just be an action hound and try to trade everything. I don't teach my students to do that. The ones that blow their accounts or fail their funded account challenges, that's a characteristic that they have. That is not a derivative of learning from me. That's a personal character flaw. And you can correct it, you can fix it, but you can't place that blame on me. If you wait and you listen, I counsel all of you real-time live on Twitter. Don't touch this right now. All right, focus on this time of the day. And when it's appropriate, I'll point to where the market's going to go to next. I did that today. The opening range gap here was utilized to get what would otherwise be done if you had done these same entries and managed the same position, would have resulted in a $9,362.50 before commissions. Now, I don't know about you, where you are in the world and your walk in life, but almost $10,000 is a pretty respectable amount of money. I mean, you can go on a nice vacation with that. You can get your spouse something really nice. You can probably do some really good Christmas shopping with that. So that's not chump change. And I want you to think about the logic that's shown here. Powell, 10 o'clock, trash market, okay? Just ignore it. Just ignore it. Just don't even worry about it. Oh, but it's going to run. It's going to move. That is you as a neophyte trader and an action hound. You feel like you have to be able to do something in that. I'm telling you with 30 years of experience, you don't need to. You don't need to. It's liberating when you just relax and say, you know what? This is the highest degree of manipulation right now, and I don't know what they're going to do, because they can manually intervene and send price careening higher or lower, and you won't be able to see it coming. So don't torture yourself. Do something else. Sleep in. Go have breakfast with your spouse. Work out longer. Take your boat out. Ride your jet skis. Cut the grass. Whatever. Don't do anything in the marketplace. Just wait. And then what time does your shift start? At 1:30. That's when the macro will start running. At 1:30, the market creates a low here. Market trades down below the New York lunch sell side liquidity again. They can sweep it again. But notice it doesn't take that low here. I don't require it to. The logic is it's going down there once more, just in case. Rallies, comes back down into this down close candle, which is a bullish order block. I'm not teaching you order blocks in this lecture. The market rallies. We have displacement again, fair value gaps and whatnot. I promise you, I'm going to take you into a 15-second chart where I utilize the information I'm going to show you here. What I saw was the market drop down below the initial New York lunch sell side liquidity. It's dropping down below here, and then I'm anticipating it to go up into that opening range gap. That's this shaded area up here. I don't need to show you an example where it goes all the way up there. I'm teaching you low-hanging fruit. That's the first threshold for you to learn under my wing. You can, and you can see it tonight, the logic is leave a partial on for that. But I'm trying to encourage you while you're learning to learn how to do this modularly, step by step. You're not going to be able to go out there and do a lot of contracts in one time. You won't know how to do the pyramiding that you're going to watch me do here in a moment. You're not going to know all that stuff, okay? And to remove all of the, oh man, I wish I would have had a partial on. I wish I would have held it longer. You don't know where your growth is going to be and how long it's going to take you to get to a point where you can trust doing that. So I allow for, and I build into my teaching, room for you to develop independent from my personal timing. See, what I think a student should require in terms of learning may be more or less than what it's going to require for you. So I'm trying to be a realistic mentor, not just someone that says, go through my workshop, go through my training in this many days, months, weeks, or whatever. You're going to come out knowing what it is you're going to do. And if you can't, then you suck. That's just not practical. So what I do is I teach you where the market's going to go. What is your terminus? Terminus, while you're first learning, is the easiest low-hanging fruit objective. So if we're buying down here on the basis that that sell side liquidity pool for lunch has been swept here, and we see this returning but not respecting a run into and below that low. It's denying that, and it showed a willingness to repel back above this low. That's what I was looking through. All of this low here, I'm looking past all that, going right to that low right there. Remember, this low here doesn't get taken out until the PM session. Look at your chart. Now, I mentioned it earlier. This low, I trusted it. But Michael, what happens if it went down there? Then I would have got stopped out. What? Yeah, sometimes I get it wrong. Sometimes I mess it up. Sometimes I bring the baggage, okay, the scar tissue or my ego into it, and I try to outperform my own algorithm. And I get my ass handed to me, and I get stopped out. If the trade's still valid, I'll go back in and re-enter. You've watched me do that. I've recorded myself doing that. Go on Twitter. It's there. It's there. If I get it wrong, you see it. If I get stopped out, you see it. If I get stopped out and it's still a good trade, I'll get back in. If I get stopped out and I'm done, I'm done. I don't hide that from you. So I'm buying under the premise that we're returning into that sell side liquidity here. One more time. What is it doing here, though? If it's not taking out that low, what is it doing? It's trading below the rejection block, which is the lowest closing price in this swing. I don't need that low to be taken out. I don't want to see it taken out. So all the understanding of price action over here, I'm anticipating this accumulation and smart money jumping on board like I was to run to relative equal highs and more specifically inside that opening range from regular trading hours where we stopped trading and where we started trading. 42, 22 and a half. That's this high in here. I could have very easily had a runner run up in here and try to get one tick below the high of the opening range gap. But if I do those types of things, some of you already get pissed off at your own performance because you think you should have 30 years of experience in performance and results too because you watched my videos or you spent enough time, which isn't realistic because none of you spent enough time to do what I'm doing. It's not ego. It's not arrogance. It's real practicality. I mean, think about it, folks. I may have 30 years of experience, but I can't pour that into you in a short period of time, and then you have 30 years of experience too. It's unrealistic. And some of you are very hard on yourselves, and you think that you should be able to do what I do. So I try to teach with that in mind, and I teach low-hanging fruit. Those terms are my way of saying, okay, if it's going to go higher, where is it going to go to logically? Well, if it's taken sell side out here, that means the sell stops have been rated there, and we swept down into the rejection block and preserved that low. And the afternoon should see a run up into that gap. And for those that are wondering why should that happen and not take out the relative equal lows, is because we've already worked below that AM session low. Remember, before we trade into, well, not traded, but transitioned into this slide here, we traded into the previous session AM lows. So we were really in a deep discount. And that opening range gap has not been traded into from the open. It opened and ran away from it quickly. It's never came up to it until here. And it left what? Relative equal highs. What time of the day did it do it? Between 12 o'clock and 1:30. So that's your lunch buy-side liquidity. Everybody that's short thinks it's going to keep going down. That's where their stop loss is. Who's doing that? Funds. Not retail Rick. Large funds. Deep pockets. Buying. And every time the market gave me a buying opportunity, very specific PD arrays, on a 15-second chart, I was entering. This is a 1-minute chart, by the way, if you're looking at it here. It's 1 minute. Every one of these entries were based on a 15-second candle. I recorded it. I've already shared it on Twitter, but for the folks that don't have Twitter or refuse to watch it because they don't want to be on the Bird app or whatever, I got you covered tonight. But every time it reached above relative equal highs, I'm taking a partial profit. Up in here, another partial profit. Above this high in here, partial profit. And above the high here, partial profit. So I don't require it to trade above this high. And I'm teaching you that you don't need to do that either. I mean, if you got out just with this, 44, 22 and a half, that's below the actual liquidity above this high. And if you mimic this same trade in your own account, whether it be funded or in live funds, and you profited $9,362.50, are you going to beat yourself up because you didn't have that run up to the opening range gap high? Some of you might, and that would be unfortunate. That's not what I want you to think. That would be really a toxic mindset about your performance and what you're trying to do. You try very, very hard to filter out negative thinking. That's why social media is the worst. Social media is like cancer, okay, for a developing student, because everybody's got an ego. They're all pulling their dicks out for a measuring competition, okay? And the point is, you're trying to learn how to make money. And all I'm trying to do is teach you how to stay in the game long enough so you can keep your money, learn the skill sets I'm showing you, so that way you can leave your fucking job and then live your life and do whatever you want to do, okay? And you don't need to listen to me the rest of your life. I don't want to be doing these videos. I don't want to be doing it. So I'm leaving you a legacy so that way you can come back to this information, take your kids to this information, whatever, and build legacy wealth. You don't need to entertain these people's egos. You don't need to come back and keep me feeling good about myself either. This stuff works. But you have to graduate in your understanding about where's it going to go and be realistic. And then over time, when you start seeing this unfold, reasons for it to go higher, you leave a runner on. That's the only way. If you're in there trading and you're thinking to yourself, man, I don't know, I should probably leave a runner on there. I know if I leave a runner on, it's probably going to stop me out. And if I don't put one on, it's going to run. Well, put one on. What's the worst thing that's going to happen? It's going to stop you out in profit. See, you're wrestling with being right. And many of you are trying to do that if you're doing it in front of an audience. That is hard. Because not only are you wrestling with your internal dialogue about what you should do and how you're managing the trade, but you're inviting everybody else's feedback to your trade. And guess what? Guess what, cowboy? That's not your trade anymore. You've invited the entire community that's watching you and your audience to manage your trade for you. And that means you brought in a level of uncertainty, fear, pride, and pain that would otherwise not be there if you were just quiet about what the fuck you're doing. That's what this is all about, folks. It's not about getting out there and showboating and show what you can do and prove this and prove that. Is it going to matter when you're paying off a house? How many people believe you did it? How many of you are going to have to come back here on social media when you hit 7 figures and you're a millionaire? How many of you have to come back to social media and go to the usual suspects and say, ha ha, ICT made me a millionaire? If you think that, you're doing this shit for the wrong reasons. The people that are really killing it, they don't come to my Twitter. They don't leave comments in my section of my videos. They don't do any of that stuff. They're out there living a life. They've already thanked me. They've already shared their testimony, and they're doing big wheel shit. Grow like that. All right, so this is a 15-second chart, and I have to make sure that I don't play sound on this, and I got to make sure I do this correctly here. I recorded a song, as I typically do on Twitter. I love Twitter for that reason. It's like a text message to you. Like if you had my personal phone number, and yes, there's a lot of people that have it, and yes, they fucking abuse it, and yes, I'm changing my phone number in November. A lot of you that listen to me or follow me on Twitter, when I'm tweeting, that's the same thing if you were like my best friend, and I'll say, hey, look at this market here. That's real time, right now, right from my mind, right into Twitter, and I can't put the music on in a presentation format that I loved doing over the years. I used to be on Twitter before leaving it. They started censoring me, and I left it. And I came back, and one of the things I was looking forward to was going back and doing vignettes where I record myself executing, putting on a trade, putting a stop loss on, managing it, putting on a pyramid position, building it up, taking profits, and watching the position go from beginning to end. And I usually put a song on there. It may not be the type of song that you like. It may have foul language in it. It may be a genre that you don't like. I don't give a shit because it's what I like. Okay, I like doing that because it's just what I like doing. It's usually received well in the community, but I can't play that here because I'll get a copyright strike, and I don't need all that shit here. So I'll leave a link so that way you can look at it in the format that I gave on Twitter, but you don't need it. It's going to be the same thing here. As a reminder, every candlestick you're seeing here is a 15-second duration. Now, think about that lunch sell-side liquidity pool and where the market was going to go up to. Now, right now, you're looking at the dollar index. It's going to change over to index futures, but I want you to think about what I showed you before we got to this slide here. Because when the video starts playing, it's like 2 minutes long, and I'll walk you through as much as I can. But everything that has already been told to you tonight, that's what I was using. Okay? I promise you, I didn't have something secret. Okay? Everything that I taught you tonight is exactly what I implemented here. And everything I'm commenting and annotating in the chart, real time, as I'm recording it, that's what I was seeing. So I try to do as much as I can in terms of annotating the chart, showing the reference points, where I think the market's going to be respecting certain levels and why it should behave a certain way. Keeping in mind that I'm doing this with 15-second candlesticks. So I have to know what the fuck I'm talking about to be able to do this. To be able to annotate it, show you where the levels are going to be respected, how it's going to reach up to this and do it. Think about, seriously, folks, think about what would be necessary to be able to know what's going on. If you're just simply looking at the 15-second chart like everybody else on Twitter was doing today, and they watched it and look at the comment section, like, what the hell? What the hell's going on? What 15 seconds? Forget the time frame. Forget the time frame. Think about what I told you tonight with the lunch macro. It's running down to the sell side, and it's going back up into that opening range gap to take the buy side on the New York lunch high, where the buy side is. That's all that I'm doing, and I'm going to use every PD array that is discount. I'm going to put in every one of these things could have been your individual entry based on the things I've taught just using a 15-second chart. Now, there's other things if you were looking at a 1-minute chart, far less entries, obviously, but you could see certain entry patterns or PD arrays to get into the trades based on a 1-minute chart, 2-minute, 3-minute, 4 or 5, or a 15-minute chart. But you have less entry opportunities the higher time frame that you go. So just to add insult to injury for the people that say this is bullshit and it's faked and all this other stuff, I go into these ultra short-term time frames just to overkill, just to rub their nose in it, to show you that this stuff works and it will work for you. It ain't going to work for you the first time you watch the video. It ain't going to be working for you because you watched a couple videos and you wrote a couple sentences down and you think that's journaling. You're going to have to really roll your sleeves up and dig into this stuff and study it. It's a lifestyle. If you don't make it a lifestyle, forget about it. It's not going to work for you. You have to be passionate about it. All right, so I'm going long here on the S&P. Here's that run that didn't take out the low at 1 o'clock. And I'm adding and pyramiding, and I've already annotated that fair value gap and told you that it's an inversion fair value gap. That means it's going to go above it, treat it as support, and then rally up into the buy sides that I'm going to show you here. So you can already see that 44.22 even level is highlighted as buy side liquidity. Notice it's below that high I was showing you when we were covering the lunch liquidity. So that's an order block. It's reclaimed, and it dug into the inversion fair value gap. And for the folks that are thinking, oh, the order block doesn't work, see here, that entire range is the order block. And I'm adding into it here inside the fair value gap that is already identified as an inversion fair value gap. So this is going to be dynamic support here. Watch how it respects it. I've already shown you here it's going to go up. And just like magic on a 15-second chart, look at that. It's unbelievable, isn't it? Now, my stop loss is below the inversion fair value gap, and I'm showing you where the executions are. So everything matches now, folks. This is not replay, none of that bullshit. There's another partial here. And my stop is below the low at 44.16. I don't want to chase it up there because that's inefficient. It can trade down inside that, so I don't want to put a stop loss at 44.17 and a half. It can come back in there deeper. I'm making allowance for that. So my stop is staying below that. I'm not in a hurry to guarantee higher profits. I'm more concerned about my limit orders filling. My stop is not being concerned about. And here comes another run up into a 10 lot limit order that would put me at 5 remaining. See that retracement down in there? I'm not worried about that. You might be freaking out because you put your stop loss higher, or you maybe even stopped out. But this is proper stop loss management. And here's the limit order, and then now we're going to run for that buy side here. And then once it runs that high, I'm wanting to trail my stop loss up then. This is exactly what I shared on Twitter today. Everything was recorded. This is not market replay. This is not the trading view replay. None of that stuff. Okay. The logic that I showed here doesn't show everything that I taught tonight, but what I was utilizing, because you don't hear me talking in the trade. But the things that I'm doing to trade this, everything I'm doing is what I was teaching you tonight. It's not conjecture. I didn't form fit it. I do this stuff every single week with you all on Twitter, over and over and over again. And when time permits it, I'll give an example every single day. Today, I gave several examples. This one today, I told you to wait for the PM session. That was the morning advice. And I went in there and murdered it. So every single one of these individual entries, that could be your model. Some are better in terms of where their entry was, but I'm using them as pyramiding opportunities. None of the things in here that I showed violated any of the bullish order flow. This is real order flow. Notice there's no DOM, depth of market, level 2 data required. No book map required. Everything that I've outlined here is shown to you on a time-based chart. My partials are based on liquidity. Look at my exits on the partials. They're at the highs. My entries are in very key levels that would be a discount array for what I've taught you. And I've done so on a 15-second chart. That's not even a minute. It takes 4 of these individual candles to make 1 minute. Does it look like noise to you? Look at how the market reacted right there. I time traveled, folks. I time traveled when we were down here. I drew this out and labeled it inversion fair value gap. For the folks that have been following me for the last couple weeks and month or so, probably 2 months, I introduced the inversion fair value gap. Okay, so every one of my PD arrays can be utilized as a contrarian entry. But unless you have the narrative in mind, knowing where is it going to reach for, where's the liquidity that's going to be drawing price next. How do you know that, ICT? Well, you start it with the weekly candle. Where is it going to gravitate to? I don't care if you use another way of trading, folks. I don't care if you do trade with harmonic patterns. Okay? If you use what I'm teaching here tonight, it's going to make your shit start working. The times that it fails, it's going against what I'm teaching you tonight. I promise you that is not arrogance or pride or ego speaking. Your shit ain't working when it goes against this. If you trade retail concepts with this stuff, your retail shit will start working. You don't have to like me. Okay? You don't have to tell everybody that you trade SMC or ICT or whatever the fuck you want to call me. Okay? I don't care. I really don't care. But I really want to see you succeed, even if you fucking hate my guts and you troll me and you make videos about me and all that bullshit. I don't care. I'm not losing any fucking sleep, okay? I can still do this stuff whether you love me or hate me. And I really want you to listen. And you never, ever, ever have to tell me that it improved your trading. I don't need it. I know it works. I want you to think about everything I talked about tonight and how it gives you a plethora of opportunities that will always be there. Folks, these intervals, they happen every day. And guess what? They can't hide it. They cannot hide this information from you. It doesn't require any kind of subscription to any fucking thing. It doesn't require you to do anything extra. It's simply just looking at the time intervals. Where is that pool of liquidity above and below? And where does it fit in a narrative? I'm guiding you. I'm teaching you. But teach me bias, ICT. This is all part of it. It's all part of it. Go back and look at the tweets. I've told you to focus on the PM session. What is that? 1:30 to 4 o'clock. Think. How many opportunities are going to be much more within reach for you now because you have this understanding in price? It doesn't mean you're going to be able to go out and do it tomorrow. Remember, I said in this lecture tonight that you have to go through weeks and months of back testing, studying what it's done, logging it, journaling it, and encouraging yourself in the commentary, in the chart that you screenshot, that you put into your journal, and you talk to yourself like you knew it was going to happen in advance. And you're tricking your subconscious into believing that is experience. And because you're sugarcoating it with everything positive and you're never saying anything negative, when you watch real-time price, it won't feel scary. Subconsciously, if you always looked at price action or looked at people like me or other people that you think are frauds, scammers, or they don't really know how to trade or whatever, you are literally flooding your brain with toxicity. And I guarantee you probably can't make a fucking penny trading because you've done that. This game is 90% psychological. It's easy to talk yourself out of it, and it's easy to program your mind to keep you in the game. Before you really know the skill set, you have to cheerlead yourself. Nobody's going to be able to do it for you. Just watching my videos is not enough. I promise you, I have paid members that have paid me, and they still can't do it because they have not done what I've told them to do. Or they think they've done enough, but they haven't. The fruits and the results will come because of what they've done. And they got to leave the bullshit at the door when they come in. They can't bring in Wyckoff theory and harmonics and other stuff and try to blend it together. You have to learn this first. Forget all that stuff. Learn this. And then once you understand this, it's easy to go into a John Murphy financial, technical analysis of the financial markets. That's the retail trader's Bible. Everything in that book can be contrarian if you understand this. But same side of the coin, if you flip it over, you can make those retail concepts work if you understand this premise tonight. See, the problem with retail traders is they don't look at the market like this. They're looking for patterns, for pattern's sake. They're looking for indicator confirmation. They're looking for things that cuts through all the, they think, noise or uncertainty or randomness of price action. If you're believing that price is random, what the fuck are you thinking the indicator is going to do? It's not changing the randomness. It's just adding something else to believe in. So that's not the right way. The right way is understanding why price delivers the way it does. And it does on a basis of time and price. There's a time that it operates, and it's reaching for a very specific price. I've already taught you the time elements, and tonight I've already taught you the price elements, time and price. Between those two, you will always have a setup for life. You can have a breaker, you can have a institutional order flow entry drill, you can have a fair value gap, an inversion fair value gap. I did this trade today to rub the nose of the guy that was in my comment section, and no, you don't see him, but he's in the videos where it looks like my comment section is open rather, like it's usually the pre-recorded videos. I think it's what I don't think it lets you do a comment, or it doesn't look like there's going to be comments open for a live stream. But whenever I do a pre-recorded video, the section underneath the video, it looks like you can leave a comment. And I have so many people saying first comment, whatever. That's silly. But invariably, I get some goober that comes in there and will say, like, this is never done in advance. You're making this stuff up. It doesn't work. It only works sometimes. Well, that's true for you because you don't know what the fuck you're doing. But I know what I'm doing. And in inversion fair value gaps, I know which fair value gap is going to be inverted. Here it is, folks. And I've shown it to you on a 15-second chart. Like, you can't get any plainer than that. It's real. It's absolutely a real phenomenon. It's really there. But you know what makes it valid and how to predict it? Understanding liquidity. Understanding time and price. That lunch hour that nobody goes to lunch, the algorithm runs on that liquidity. And then it starts repricing and spooling to the next pool of liquidity. So since it took sell side, okay, what did I teach you? Price only goes up to take buy side or buy stops. Or it goes up to an inefficiency above market price. That's the only two fucking reasons that price goes up. Period. End of story. I don't care how many years you've been trading. You can call yourself a market maker. I don't care what institution you work for. You banked that this one. You did this trading for that one. You manage funds. I don't give a shit. Price only goes up for one or two reasons. To go up to an inefficiency above market price, or it runs up for buy side liquidity, buy stops. That's it, folks. That is it. It's not going up because of buying pressure, and it's not going down because of selling pressure. It's going down for inefficiency below market price, or it's going down for sell side liquidity. Period. End of story. That is it. If it's not doing one of those two things, it's going sideways. I already teach you and taught you. The economic calendar tells you when it's going to consolidate. So what does that leave? Up or down? Okay. How do you know if it's going to go up or down? Look at the weekly chart. What is it going to reach for on that weekly candlestick? Something above the price or below the price? Which is the most obvious? There's going to be a fair value gap or liquidity. Which is the most easiest, closest proximity PD array? It's probably going to go to that one. But what if you're wrong? Then you fucking lose. What the fuck? You're going to lose. Sometimes you're going to lose, folks. You're going to get it wrong sometimes. Why are you afraid? Look at how many new opportunities are made available to you now. You have information that is not found anywhere else. I have laughed at all these fucking clowns for 30 years on the internet, pretending they had some kind of holy grail. And they're clueless. They're absolutely clueless. And they perpetuate and regurgitate all the stuff that I've bought in books. Over 2,000 books. And it's all horseshit. And I just can't bring it to throw it. I can't bring myself to the point of throwing them away. Because number one, I spent a lot of good money on it. I worked hard for that money. And it just reminds me of what I had to wade through. And all the horseshit and lies and garbage that people believe that makes these markets move up and down. And it's all horseshit. It's a waste of time. All the things that you think is going to make the price go up and down, if it's in a book, unless I wrote it, it's all horseshit. And yes, I just let pride and ego speak right there because I can do it. I have the authority to do so. You have a setup for life if you use this information. I have given you the freedom to be able to pick what your entry model is going to be. Which one are you going to use? Is it going to be an order block, a fair value gap, optimal trade entry, inversion fair value gap, turtle soup, consequent encroachment of a wick? All these things are left into your hands. And I'm making allowance for that because I don't know where you started in my videos. And if you're wondering where to start, the 2022 model or 2022 mentorship, it's 41 videos. I promise you, if you start there, you'll get the shortest route to going into the charts and finding something that works every fucking day. Every day it works. Every day. Now, here's the caveat. It may not work in the market that you're looking at right now, but it's in every single one of these markets. It's in there. So what does that mean? If you're an index trader, it will be in one index. It may be in multiple index, but it might only be in one. And that's why I teach you to look at all three of the averages, the Dow, the NASDAQ, and the S&P. It may not be in the pound, but it is in the euro. You see the difference? That's why I teach at least a triad. When I taught predominantly only Forex, I was teaching dollar, euro dollar, and pound dollar. You can't miss it then. It's there. You have to have intermarket relationships and study like that with a closely correlated market. Euro and cable, or euro dollar and pound dollar, are closely correlated. They're inversely correlated with the dollar. So when the dollar goes up, they go down. But just because the dollar's going down doesn't mean it's a good buy to be in euro. Sometimes it's a better buy in cable. Most times it's better than cable. Better in cable, rather. But there's going to be times when the dollar is going sideways. And the euro or cable may outperform one or the other. What does that mean? It just means that the real trade is not in that one. It's in the exotic. Meaning that you can use the pound dollar if it's really running, or it's predisposed to go up more if the dollar is consolidating. That means you probably have a really good trade long in pound yen. Don't take my word for it. Just consider it. I've done lessons in core content about that stuff too. Those videos are not coming down in November. Everything on this YouTube channel will stay. I won't be here updating it after November, but I promise I will leave you with more than you will ever need. And you study at your own pace. Don't rush. If you rush, it just makes your learning curve longer. You can't speed learn this. You can't learn. I saw a guy. I watched all of ICT videos, and I've condensed it into 15 videos. And now you can do it quicker and sooner and faster and more efficiently. That's bullshit. You hear that? That's me laughing at your fucking ass. You are a clown if you think you can take everything I've done and condense it into the smallest little time frame of a presentation. You're going to miss so much information. There's so much information in the stuff I've given. And you don't even appreciate what it is because you just went through it one time and you haven't even started trading with real money. And when you start trading with real money and you come back and you watch those same videos again, you're like, oh shit, he said that. I didn't hear that the first time. You're going to swear up and down that I made an edit to the video, and I haven't. It just doesn't mean anything to you right now because you're not even a demo trader yet with consistency. When you start trading with real money, the lessons and all those droning discussions, jawboning by ICT, all that stuff's going to be much more meaningful to you. It's going to be rich understanding because it'll be you that's prepared to hear it. You're not prepared to hear it. Most times you're not. And to be honest with you, I'm not talking to you. I'm talking to my children. That's what all this is for. That movie with Michael Keaton, My Life, that's what I'm doing right here. When I'm gone, they'll have all this. They'll have all this to listen to and compare and contrast with notes that I have for Enigma, which I am not teaching, and none of these presentations ever had Enigma in them. And no joker has cracked it and figured it out either. They may call what the fuck they're doing Enigma, but it ain't even close. I promise you, it's not even close. I am Enigma. Appreciate you hanging out with me tonight. Hopefully this was insightful and helpful to you in your learning. And if you could, give me a thumbs up on the video. It doesn't cost you anything. It's an encouragement for me to want to come back and do more like this. Until I talk to you next time, be safe.